Hello and welcome to NDTV Profit. Joining us on a special broadcast where we are actually sitting here a little over 7 hours since the Reserve Bank of India governor announced the October monetary policy announcement, where he said that, of course, the decision on the rates was a status quo. Interest rates remain where they are. But that was a bit of a sideshow. What actually happened was a whole host of announcements that came from the regulator on the banking sector, as well as the allied lending sector, and the many changes. About 22 new changes have been introduced into the banking system. These will be rolled out over the next few weeks, of course, and we will see a completely different regulatory piece for the banking industry. And I have with me none other than CS Setty, the chairman of State Bank of India, this evening to discuss a lot of what has actually happened and what is this likely to mean for the sector. Mr. Setty, welcome to this conversation, sir.
Thank you, Vishwanath, for having me on your show.
Sir, let me start first with the rate side of the story, because that's less relevant, but of course that's also the focus of the monetary policy. So the decision to maintain a repo rate at 5.5% now, at a time when we're just entering the festive season, do you think that this was timely, this was necessary?
No, as Governor mentioned in his speech also, I think a lot of things which they've undertaken both on the monetary side and also the fiscal measures like GST, rationalization. These things have to play out. If you remember, the monetary policy side, there was front loading of the rate, as well as the cut on the CRR, which will be playing out till December. And the GST, which has modification kicked in from 22nd of this September. All these have to be playing out, and that probably is one of the compelling reasons for RBI to maintain this rate at this level. I think is a right decision. By December, we will have better clarity, and also the stance being neutral, which, again, we'll have to see what kind of rate cut is likely to happen in December or going forward.
Understood, sir. Let me come to the broader growth impulses and the inflation side of the story. Specifically on inflation, the RBI has actually brought down its inflation expectations for FY26, even though second half it looks like it's inching up a little bit. Similarly, on the growth front, they've actually raised their expectations on growth from 6.5% to 6.8% for this financial year. However, the second half of this financial year, it looks like the growth might be tapering down a little bit because they have revised it lower for those last 2 quarters of this year. As the preeminent banker of this country, I'm trying to gauge from you, what are you seeing in terms of inflation and growth impulses going ahead for this fiscal?
The inflation number was anticipated to come down anyway, but I think a substantial reduction in the inflation number, almost by 1%, definitely is a surprise. While they're saying that, going forward, 26, 27, inflation is expected to go beyond 4%. That also probably one of the reasons why they wanted to be a little cautious on the rate cuts. But we see that there is a moderation of inflation across the economy, particularly in the financial sector, where whomever we are talking to, we are given an impression that there is a moderation in the inflation trend. As far as the growth is concerned, yes, I think as acknowledged by the governor, the issues related to tariffs, geopolitical uncertainties, definitely have some impact on the expected growth rates. While the Q2 number seems to be good at 6.8, overall 6.8 growth rate for the year, but the moderation in the subsequent quarter from Q3, Q4 indicates that the impact of tariffs has to play out clearly going forward. We'll have to see how it is going to impact.
Let me come to a topic that you have mentioned in recent interactions, which was about acquisition financing. That's something that the RBI has actually opened the door to. We don't know what the final guidelines are going to look like, but clearly this is a step forward in making banks more competitive in the global scenario. I'm trying to understand from a lender's point of view why acquisition financing is so important for a bank in India.
It's not the question of being important. I think the M&A activity has been robust in Indian context. For almost 2 decades, Indian banks have not been allowed to be participating in the M&A financing activity. If you see the opportunities in calendar year 24 itself, the total M&A activity aggregated to about $120 billion, the way the Indian corporates acquired Indian entities themselves. So while foreign banks are permitted to fund these acquisitions, Indian banks were kept away from this. And this is a level playing field which Indian banks have been asking. And banking sector in India is much robust now. The balance sheets are repaid and capital ratios are comfortable. So I think it's time, appropriate time, and I think it's a best time in my view to have a review of this 2-decade-old norm of keeping away the Indian banks from the M&A activity. From that angle, I think both from an opportunity side as well as providing the level playing field to the Indian banks, I must compliment the RBI and the governor for taking this important step, which we have been requesting for quite some time.
Understood. I want to dig a little bit deeper in this question. Now, there is a lot of competition that's coming in from the private credit front as well, because they are able to provide that acquisition financing, which promoters are maybe not able to access through banks or traditional financing routes. Is this a consideration for you? Because this competition is unchecked and relatively under-regulated. Is that also an issue in consideration?
See, one thing, as you mentioned, Vishwanath, we have to see what kind of framework is going to be put in place. What are the guardrails which they're looking for? So while we keep that aside for a moment, I don't think we are looking at reducing or replacing the private credit. The private credit is highly structured credit. I don't think banks will be able to get into that kind of transactions, even if we have to look at it. That has to be pursued separately. Even if we have to do, I think we have to do private credit through a vehicle, maybe through asset management companies or any of the venture capital funds, what banks have. But otherwise, the replacement of private credit by M&A financing is not the objective. But obviously, some of the transactions which are plain, straightforward M&A transactions are also not being funded by the banks, Indian banks now, is something definitely we can start with.
And the concerns around, say, underwriting or maybe checking the value of the deal and appropriately backing it, that's not something that concerns you at this point in time.
See, there's a lot of maturity has come in the banking sector in terms of underwriting, and the robust data is available. And assuming that either the acquiring company or the target company are listed, there's much more scrutiny of those transactions from the shareholders' point of view. And the valuation methodology is broadly, is stabilized. I believe at least some major banks in India are capable of funding this transaction. And mind you, most of us also do M&A financing abroad, where the target as well as acquirer is a non-Indian company. Our Indian company acquiring a non-Indian target is still permitted to be funded by Indian banks through their foreign offices, which means that we have adequate understanding about this M&A activity.
Mr. Setty, thank you so much. Let me come to the other part of the regulatory announcements that the RBI has made, specifically around the large exposure framework. Now, they're talking about the banking system level limits that they had originally introduced, 10,000 crore being the upper limit of how much banks can lend as a group to one single corporate. while they're continuing with the internal limits of banks, these external limits are likely to be done away with, and we will probably see a new framework come into place. I'm trying to understand from a lender's point of view, how much of a leeway is this for you?
It is definitely a leeway, Vishwanath. I'll tell you, in simple terms, what happens if SBI is taking an exposure on a corporate. We have our own internal limits, both on the group exposure limit as well as individual borrower limit. These are to avoid the concentration risk at the bank level. But this exposure framework also mentioned that if any of this corporate entity has an aggregate credit facilities of 10,000 crores, they are necessarily have to borrow from the market. This is to avoid the concentration risk from the banking system, because such market mechanism, whenever the corporate is accessing the market by through way of NCDs or any other bonds or CPs, we are not supposed to be participating there. Even if we participate, that also get counted in 10,000 crores, current limit of aggregate limit of credit facility, which means that these are the norms which have come in 2016, almost 10-year old, and the requirement of corporates, particularly on the capex side, has gone up. We have seen even, and there are no exemptions. For example, even a central PSU is undertaking the large-scale investment in the capital expenditure, and they're along with their working capital limit, if they exceed 10,000 from the banking system, they're mandated to go to the corporate bond market. While it also helped the corporate bond market to develop, but the restriction placed on the banking system to not to exceed 10,000, even if you exceed and you make an additional provision, was, I think, kind of archaic in our view, and it's a bold decision by RBI to do away with the specified borrower category, while the individual concentration risks at the bank levels are avoided by continuing the large exposure framework at the bank level.
I also want to ask you about the time when these guidelines came into play, right? Back in 2016, the situation in the banking system was quite different. More often than not, 10,000 crore was a very, very large sum. It may not be now. You know, over the last 9 years, that capital base has gone up so much that 10,000 crore doesn't seem that much money now. But have those worries of the concentration risk, have the worries of banks taking on excessive exposure towards a single company, have they gone?
No, they still are valid. They still are valid in terms of the individual bank exposure norms, which are linked to the capital of a bank. They still are going to be monitored, and as the monetary policy announcement also says that if they see that any undue concentration risk is emerging, they would definitely address through the macroprudential norms. That is what the announcement which is made. But more importantly, if you see, the credit markets also have enhanced. In 2016, the overall credit given by the banks is around 75 lakh crore. Today, we are 185 lakh crore, which means the market size has grown and coupled with what you mentioned, Isanath, in terms of 10,000 crore limit itself has become small in investment terms from a banking system perspective. So I think there are ways of managing the banking sector concentration in a particular group, but that can be better achieved by having an individual limit in the bank level.
I want to ask you last few questions now. As far as the ECL framework is concerned, now you have a date of implementation, 1st of April 2027. The ECL framework comes into play, and you have time till 2031 to fully implement it. So cumulatively, about 5 years from now is when the ECL framework will be fully at play. Do you estimate any large hit to come in this initial period, or do you think that maybe the sector is more or less set, especially SBI?
We haven't had any number in mind, but I think one is if you look at 1/4/27 implementation, I think the transition is going to be smooth, because ECL is a complex system. We need to understand. We have to have fine-tune our internal models. SBI is much better positioned in terms of implementation of these ECL guidelines. But the transition time, as well as the glide path which is given, will ensure that none of us will be exposed to any undue pressure on our capital ratios. So I don't think any matter of concern there. And the fact that when look back period is changed from maybe 3 years ago, if ACL had come, we would have had a higher ECL provisioning requirement than what we have today, because the look back period is changed. So I believe banking system will be able to absorb this easily.
So some of the measures that were announced today were focused on improving the credit flow. It was focused on making banks more competitive in the current environment that we are operating in. Do you think that we will adequately address these objectives and maybe push the RBI to do a little bit more than what they've already done?
These measures, what were announced, almost about 22, covering various aspects of banking. I call them banking reforms in a way. And some of them are have been asked by the industry for quite some time, and we are very glad that RBI had taken the initiative of clarifying some of these positions. One is these measures were overdue in a way, and the clarity had to emerge. These will definitely make things easier for the banking system, not only for banks themselves. It is for the corporate world, it's for the borrowers. For example, Basel III norms, as mentioned by the governor, will bring down the capital allocation which is required currently for MSMEs and real estate sector, residential particularly. These are the sectors which are witnessing a good growth, and they are very critical for the Indian economy. So I think from that angle, they're value accretive, both from a credit growth perspective, ease of doing business perspective. There's a host of measures what governor has announced in terms of exporters, the way the export proceeds are managed in the gift city. I think the far-reaching, they may sound as small measures, but have a very big, impactful outcomes.
I want to ask you one last question, and this was one of the measures that was announced, and I think this is also something that banks have been asking for a very long time, which was a risk-based premium setting of this deposit insurance. Banks have constantly said that why am I paying, if I'm running a very successful franchise, why am I paying the same insurance premium that somebody who's not running a very successful franchise is paying? Do you think that this is the lens that we should look at it from, or is there another viewpoint here?
No, I think it's a plain view. What we have been asking is that, and the risk-based premium is not new. Globally, many countries, risk-based insurance premium is charged for the deposit insurance. So this is something what we've been asking, and we'll have to see how the model is going to be, framework is going to be announced by them. But I think this will ensure that one is the risk management itself gets strengthened. And the number two is that today the DICGC, our deposit insurance premium, is one of the most, the largest item in my overheads. A bank like SBI last year had paid 5,400 crores DICGC premium. Whereas, there's no differentiation, SBI being a large bank, state-owned bank, robust risk management in place. But we pay the same premium what all other banks pay. So this is definitely a good measure, number one. Number two, it is not impacting the customers in any manner, in the sense that the customers will continue to be protected to the extent what is now currently covered. So this is a very important development in the overall 22 measures. If I have to, take out two important ones, one is on the M&A financing, the other one is DICC premium, moving to a risk-based premium structure.
So much for being patient and staying with us through this entire conversation. And thank you so much for sharing your views, sir.
Thank you. Thank you, Shina.
All right. So that was CS Setty, the chairman of State Bank of India, telling us what he thought of the 22 different measures that the Reserve Bank of India had announced earlier today as part of the developmental and regulatory measures that the RBI took as part of the monetary policy announcement. Thank you so much for watching NDTV Profit. Stay tuned.
Thank you.